Hi, this is Keith Schneider, CEO of MarketGauge.com, and it's June 12th, 2022 edition of Market Outlook. All right, so pretty nasty week, ending on a really bad note with CPI and inflation numbers across the board looking like it's out of control. Obviously, that had a bad impact on the markets. Let's take a look. So, first of all, a couple things to note. On a technical basis, we had sort of a classic chart pattern, which is a gap and a closing low for the week. So that breakaway gap on the downside, not a good sign. The other thing to note is that the Dow, the Qs, IWM, and the S&P all are in bearish phases. Now, one thing that was interesting, earlier in the week, IWM actually moved into a weak recovery phase that quickly fell. So, net on a weekly basis, most of the indices, 3 out of the 4, basically closed right at weekly lows. Not the absolute lows that we saw earlier this year when we had a pretty strong one-day recovery. But on a closing basis, 3 out of these 4 indices closed on absolute lows. Now, a couple of things. Sometimes it's good to step back and really take a look at the weekly charts, and this is a perfect opportunity. So one thing you can see is if you take a look at the S&P before COVID broke out, the highs in 2020 were basically just under, well, actually, let me move this back up here. Hang on. What's interesting is that the 200-week moving average sort of coincides somewhat, right, to the highs in 2020. A little bit below, but you can see a spike down and basically this 260 level here, 262 in the Qs, coincide with this the highs in 2020. Similar pattern here in the S&P, where the 350 level also coincides with the 200-week moving average. In terms of the Dow, similar level also as well, just above 295, 300 level. Now, the one exception that's interesting is that IWM had been finding some support because it actually got hit the hardest, but has been finding support where the old 220 highs before COVID broke out and the 200-week moving average coincide. So these are important support levels to monitor if we do go into what would look like a free fall following these bad inflationary numbers. Okay, now moving on, one key intermarket relationship that we always like to monitor is looking at the S&P versus utilities. So you can see we got a nice bounce. Things were looking a little bit better, certainly on a shorter term basis, but that gave up the ghost on Friday with the big sell-off in the market. One thing you can see here, and this is interesting to note, especially when you look at these ratio charts, is that even if the ratio is improving, it doesn't mean that one thing is a better opportunity to buy. So at the moment, if you take a look here, we actually lost a bull phase in XLU utilities, and of course the S&P never made it back over its 50-day moving average, and hence we're still in a bear phase. So with this retreat in utilities backing into a warning phase and stocks in a bear phase, what's interesting, of course, is what that's showing is risk off is in favor but all asset classes are getting hit. Doesn't make utilities necessarily a buy. Okay, now moving on to volume analysis, you can see here that we still have more distribution days across the board. Interesting, S&P is actually the strongest out of the bunch. It has 2 accumulation days, 4 distribution days, but net overall, obviously with the sell-off, volume is confirming the weakness here in the market. We had a really bad week, down over 4.5% across the board, with the NASDAQ the worst with minus 5.67%. And again, you can see here we're not far from bear territory in both the S&P and the Russell 2000 if you use the 20% threshold, but obviously overall, with the NASDAQ down 27%, we're in negative territory across the board. So now looking at sectors, one thing that's pretty clear is every sector got hit this week, negative performance. Now the thing is, energy was down marginally, only down 0.9%, with the S&P down over 5. So net inflationary pressures are still there. The other thing to note is the thing that got hit the hardest, semiconductors, down 7.4%. That is the most speculated sector around. Not good. The other thing, in terms of a contracting economy, people really getting nervous about, gas prices over $5 a barrel, $5 a gallon, down 7%. So this is definitely a lead indicator on just the overall economy. So not a good reading across the board regarding sector performance. Now, moving on to what's hot, what's not, a couple of things to note. And I'm just going to probably re-emphasize what I've said before, right? If you can see here for the week, what led corn was up on the week, up over 4%. Natural gas, obviously volatility picked up quite a bit as well. But what is most interesting is commodity prices definitely showing inflationary pressures, and staying ahead of the game here is keeping an eye on this inflationary situation. And of course, the other thing to note that is interesting is China was up on the week, and the only foreign equity market that was positive. So interesting. It's also a position that we have well ahead of the game here. We're up about 20% in China in Mish's discretionary portfolio. So staying nicely ahead of the curve there. So net, you can see, again, technology down big on Friday. And so just across the board, semis down also big on Friday. But it had been under pressure for a good part of the week. All right, so here we have it. Markets look like they're definitely going to be under pressure. Interest rates look like it's going to be inevitable that things are going to have to, rates are going to have to rise. That's going to put pressure on liquidity and equities, and that's the theme for the moment. So stay tuned. Good luck with your trading. See you next week. Keep those stops in place, and bye for now.